everyone, and thank you for watching my videos. So far in my previous videos, we talked about the many different ways we can achieve success in the Forex market. But in this video, I have to take some time to talk to you about leverage. Because leverage can, if you don't understand it, can hurt the Forex investor very much. So we need to take some time to learn about leverage and how brokers use leverage, how investors use leverage, and how the broker benefits and how the investor hurts. Okay, so the number one reason why new traders fail is undercapitalization. You see, if we don't have enough in our accounts, then we lose that amount quickly. So we have to remember, the smaller the capital, the easier it is to lose it. Now, it is recommended that if we want to trade one standard lot, you should have at least $100,000 in a standard account, or $10,000 in a mini account, or $1,000 in a micro account. Now, you're probably saying to yourselves, whoa, I definitely don't have that amount of money. What do I do? Well, that's why we trade with leverage, and that's why we trade on margin. But we need to use those wisely so it doesn't hurt us. And this actually goes along with my previous video on risk management. Now, let's talk about the dangers of margin trading. So, new traders, who open up a Forex account with the minimum deposit do so because they don't understand the terms leverage and margin and how it affects their trading. So just because your broker says $250, that's all you need, $500, that's all you need, that doesn't mean put only $250 or put $500. What we want to do is we want to use the largest amount of disposable capital as possible, because the larger the capital, the easier it is to stay in the market long enough to make profits. If we only put $250 in our account, we're going to lose that quickly. Now, it is crucial that you're fully aware and free of ignorance of the significance of trading with leverage. So, after this video, we need to know exactly what leverage is, how brokers use the leverage, and how investors use leverage, and how it helps the broker, benefits the broker, but hurts investors like you and me. So let's talk about margin calls. On our trading platform, we'll see this. Okay, so here on this chart, we have our balance, we have our equity, we have our use margin, and we have our usable margin. So when we are monitoring what's happening in our accounts, when we are managing how much money we have in our accounts, we'll see something that's quite similar to what I have on this slide. So let's explain usable margin. Now, let's say we place $10,000 into our account. So if we place $10,000 into our account, that will be our balance, as it's indicated here, and our usable margin, in which I have this red arrow pointed to. Usable margin, that means the amount of capital that you can use to make a trade. So whatever you place into the account, that's how much we trade. Also, here's something else we need to know about the usable margin. This is what you will see when you first open an account. So again, we put that $10,000 into our account to open. We have our $10,000. Or if you're opening up in a demo account, your demo account might have 10,000 virtual dollars, and this is what you'll see. Okay, and again, your usable margin, it will always be the same as the equity minus the use margin. So equity, again, this will also tell us how much money we deposited in our account. So again, we just opened up our account, no positions taken. So we have balance, equity, and usable margin the same. So equity minus used margin equals usable margin. Okay, so let's talk about equity. Equity is how valuable your account is. The amount of equity determines if a margin call has been reached. So, how do we determine equity? We add use margin, use a bull margin. Our use margin is 0 because we don't have anything invested. Use a bull margin, meaning how much we can invest. 0 plus 10,000 equals 10,000. Now, use a bull margin after purchasing one lot on the euro-dollar pair. Now, so here it appears that we have opened up a mini account. Why do I say mini account? Because I'm assuming that our broker is giving us 100-to-1 leverage. Now, let's say we open up a position. Here's what happens. $100 has been taken out of our account, and we are left with $9,999. But that 100, the broker is holding the 100, and that gets placed in the use margin. Use margin of $100. It means the broker is holding it until we close. So remember, if we're trading on 100-to-1 leverage, what that means is we are investing 1% of the position that we've opened. Our broker takes care of the other 99%. But what the broker is really doing is that broker has opened up a position, a standard position, well, not standard position, I mean a mini lot, which is 10,000 units, on our behalf. And because he's doing that, he or she is doing that, that broker has removed 100 because that's our 1% commitment. Okay, so we purchased one lot. Our usable margin is $9,900. Now, let's say we are buying the euro, selling the dollar. So here we can see that we are trading on a leverage of 1 to 100, since only 100 of your capital is being used to trade 100,000 on your open position. So again, we're talking about a small percentage. That's our leverage. Now, let's go back to use margin. Now 100, that's being used while your position is open. This money will be returned to you when you close the position. So we opened the position. We opened a long position, meaning we bought the euro, sold the dollar. But when we close the position, we're taking the opposite position, meaning we are selling the euro, buying the dollar. Now, use margin. So again, the broker is holding that $100. It will be returned to us. So let's talk about equity. If you close this lot to buy, selling the euro at the same exact price in which you bought the currency, the equity will remain unchanged, and your account will be the same as if you opened it. So it means if we close the position at the same price in which we bought it, meaning we did not make any profits and we did not lose anything, then our account will be exactly the same as before. So let's see we opened 80 long positions on the euro-dollar pair. So I just showed you what happens if we open one. Let's talk about 80. Whoa. Now our use margin is $8,000. That means our broker has removed $8,000 from our account and is holding that $8,000. We only have $2,000 to use in the market. So now our equity will not change, because in theory, if we close all 80 lots at the same time in which we ordered them, we will return them to, they will return to your original position. And our use margin, again, we can see that 8,000 has been taken from us, or not taken permanently, but is held until we close the position. However, we can see that 80% of our capital is in the market, and we only have access to 20% of the capital. So which means we only have limited amount of usable margin to provide breathing room. So this is kind of a very dangerous position we're in. We really don't want to be in this position. It's really not good when the used margin is higher than the usable. We want the usable to be higher than the used. Now, let's look at equity and usable margin. The usable margin tells us how far your equity can be reduced before you lose your positions due to margin call. So we want to look at equity and we want to look at usable margin. How long can we last? Now, having 80 euro dollar lots means 25 pips in the opposite direction means you can lose 2,000 in a matter of seconds, which means if this usable margin goes down to 0, our broker will close our accounts. And even though our used margin will be returned to us, we have lost the 2,000. So here I've made some calculations. So we're talking 1 pip times 80 lots, $80 a pip. And then as we continue with the calculations, we can see that if this usable margin goes down to 0, that's it. We're finished. But we're not at 0. It just means we're finished with that investment. That's called a margin call. So here's what your account will look like at the end of margin call. So our balance will change to 8,000 because balance, well, that just means how much you have in your account. Here's what your account will look like at the end of the margin call. The money from your used margin will be lost. So again, we've lost to 2,000, that's gone. But we're still with our 8,000 because our broker just took the 8,000, held it, but when that position closed, it gets returned to us. Just like when we open and close a position, we close the position when we want to, our broker will return what we've invested to us, providing that, but except for what we've profited and lost. Of course, if we profited, then we gain, and that gets added to our balance, but whatever we've lost will get reduced from our balance. So that's how that works. Okay, so let's talk more about the dangers of margin and leverage. Trading on margin increases buying power, and also having 5,000 cash in your margin account that allows 100 to 1 leverage means you can trade up to $500,000 worth of currency. Both profits and losses are magnified. So again, the broker offers us 100 to 1 leverage, so we can trade on lots even though we only have such a small amount of capital. So there we have it for leverages. Okay, so some more information we need to understand is we must understand the risk before trading and learn more about your margin account. So again, we need to learn how to read that ledger. We need to learn how to read that strip of information. We must know the difference between usable margin and used margin, because that is also the key, because we don't want to be margin called, and we need to be able to monitor the equity. We need to be able to monitor the used margin and the usable margin, because that tells us how much danger we're in. So again, we don't want that usable margin to go down to 0. We want that usable margin to be high. We want that usable margin to be higher than the used margin because we're safe. If the used margin is higher than the usable margin, we're in danger. So remember, used margin is higher than usable, then we are safe. If usable margin is lower than the used margin, we're in danger. Okay, so also more negatives of leverage. There are 2 types, maximum and true. Some brokers give you the option of selecting your own leverage, and most brokers require you to have leverage usually around 1%. So if we're starting out amateur investors who don't know much about the market, then usually our brokers will give us 100-to-1 leverage, and that's just what we work with. So again, let's look at the ledger again. So remember, in order to receive a margin call, the price would have to move up 100 pips, 5,000 usable margin divided by the $50 pip. So again, we're looking at the use margin, we're looking at the usable margin. So we want the use margin to be higher to keep us safe, and we don't want the usable margin to be higher. That puts us in danger. So again, it goes back to the previous video on risk management, because if we risk a small amount of capital, like say 2% of capital, then we don't have to worry about the usable margin going down to 0. So remember, apply risk management to what I'm telling you in this video about leverage and margin, and that can help us immensely and keep us in the market to make those big profits. So also some more information about this ledger. In order to receive a margin call, price would have to move 9,900 pips, 900,000 usable margin divided by $10 a pip. So let's say we have $10,000 in our, $100,000, excuse me, in our balance. And let's say we have 1,000 invested into the market. That means our usable margin is 99,000, which means we can keep this position open as long as we need to and then it makes it easier for us to be patient and to receive a profit once the market has gone the other way, and then maybe it can reverse itself and we can sit back and just wait for the market to reverse itself, because 99,000, that's a really good cushion. So we don't have to worry about being margin called. And also, let's say you buy 19 more standard lots again at the same rate as the first trade. The full amount of your position is $2 million, and your account balance is 100,000, and your true leverage is 20-to-1. So again, we have our 100,000 balance, and we have 20,000 in the market. So again, in order to be margin called, that means that 80,000 would have to be reduced to 0. So that means 400 pips going in the opposite direction. So again, we're working with percentages. Again, the difference between risking 2% to risking 10%. So we want to keep our risks minimum. And also, we need to keep our accounts well cushioned, because as we can see, if we open up really small accounts with only the bare minimum amount of capital, that hurts us. But if we have large amounts of capital to begin with, and we're only making small trades, that can help us, and that keeps us in the Forex market long enough. And going back to what I was saying before, great opportunities to learn from our mistakes, study the markets, and analyze the markets technically, fundamentally, and apply the sentiment analysis, because we have plenty of cushion to withstand the loss and determine when and where the market will reverse itself, and know when we can make a profit. And again, if you did get margin called, your trade exited at the margin call price, this is what your account would look like. So had you placed the 100,000 into your account and had that $80,000 had gone all the way down to 0, that means we would have been left with 20,000. And now I think we can see exactly how brokers make their money. So most of their profits come from margin calling. Now let's talk about the leverage chart. So after going long on the US dollar Japanese yen pair and the pair goes up from, let's say, 80 yen to 80.8 yen. So that would be a 1% difference. So as we can see, if we traded on 100 to 1 leverage, that means the margin would require 1,000, which gives us a 100% change in our account. However, if the smaller the leverage, the more the margin requires. So what we're learning here from this chart is we don't want our leverage to be too big, because if the leverage is too big, that means we're getting closer and closer to being margin called. So the smaller the leverage, the least likely that we are going to be margin called. The more leverage we have, the more likely it is that we will be margin called. And it works the same way when we either go long or we go short on a pair. So the more leverage we have, the closer we are to being margin called. The smaller the leverage, the least likely we are to be margin called. So keep that in mind. If possible, we don't want to trade on leverage, but it may be difficult to find a broker that would allow you to trade without leverage. So we might have to trade on leverage anyways. It's not a decision that we can make most of the time, but if we did trade on leverage, keep that in mind when we are funding our accounts, that we want to fund our accounts with as much capital as possible to protect ourselves in this market. So again, here's what a typical result of an amateur trader who opens up an account with only 500. So I showed you the ledgers with large amounts of capital in the balance, such as 10,000, 100,000. Now I'm going to show you what would happen if you open an account with only 500. So as we can see, if we open up 2 lots with only 500 in our accounts, that means if we place a 30 pip stop loss, then we lose $60. And we only end up with 440 in our account. However, if we open, and then let's say we have 440. Now, let's say we think that if we open up a bigger position, then we can compensate for that loss. So we do. So let's say we open up 4 lots with only 440, but we put the stop loss at 30 pips. Well, guess what? We just increased our losses even more, and we're down to 320. So now we have only 320 in our accounts. This time we've learned our lesson. Let's not make such a big order. Let's just keep it to 2 lots. But let's say we lose, and we placed our stop loss at 30 pips, but our investment went the other direction, and we lost our account at 30 pips. That puts us down to 260. Then we get really anxious, we get desperate, our emotions are clouding our judgments, so we decided to just jump into the market, take a gamble, see what happens. We open up 5 lots on $260 worth of capital, and bam, just like that, we are margin called, and we're left with 150. So as we can see, it's very dangerous to trade in the market with such a small amount of capital. So we need to fund our account with a serious amount of capital to give us a chance to last longer in this market, in order to look for opportunities to make great profits. So let's talk about transition costs. Here's what we need to know. Transaction costs can occur within the spreads, and they're also factored into the leverage, meaning the higher the leverage, the higher the transaction costs. So we want to be able to understand how much we're losing when it comes to transaction costs. Also, the pound pairs have very high transaction costs. So it is recommended that if you don't have a high amount of capital to invest in the market, stay away from the British pound altogether. And it is not recommended for inexperienced traders. Now let's take a look at this chart regarding transaction costs. So again, we have a list of different types of leverage, and also if we notice, the smaller the leverage, the more margin we have, and also the cost is reduced. So again, if possible, let's try not to trade on margin, because that can hurt us, but maybe we don't have a choice. So if we did have a choice, trade with the smallest amount of margin required. But if we can't have that choice, then make sure that we fund our accounts with as much capital as required in order to make sure that the transaction costs don't hurt us. Okay, so here's what we've learned in this video. So we need to understand that high leverage is a favorite selling point for most Forex brokers. This is how Forex brokers get more clients, because clients lose their money quickly when they don't understand how leverage works, how margin works, how transaction costs work. And also brokers, they want you to trade with a short-term mindset, because when you think short-term, you lose your money quickly, and that's how brokers increase their profits. So we have to understand something here. Casinos, sometimes they win, sometimes they lose, as I mentioned in the previous video. But the reason why casinos are always successful is because even they have a system that is designed for them to get their profits every time. Casinos have a successful strategy. The major investors in the Forex market have their strategies, and you must have your own strategy so you can achieve the same amount of success when you invest in the Forex market. Thank you for watching my video, and good trading.